why are options priced a certain way? Why was Infosys priced at 55 in the previous lesson? You see, there are various reasons for this. Many people think if the stock is going up, then the call option should rightly go up as well. That is true to some extent, but there are other forces apart from underlying movement as well. We've seen one just now with Infosys where the movement of Infosys was nothing and the call option practically went almost to zero, right from 11 rupees 60 paisa to almost 10 paisa, and there was almost no movement in Infosys. That is, of course, as we know, as time decay. We call that the theta. Now, to understand the option pricing model, first thing you need to understand is that it is theoretical. You get a good ballpark image of what the option pricing will be. Options with different strike prices tend to move differently, and we need a mathematical model to solve these things. And those are the Greeks. These are the stars of the show. They measure everything from time to volatility and whatnot. Let's go by them one by one. So let's see the first one. It's called the delta. Now the delta measures how the premium will move for each point in the underlying. The delta gives you an estimate of how much your option contract will move for every 1 point of movement in the underlying. Now let's say a stock is trading at 200 and you are bullish on it, so you buy a call option which costs you rupees 30. Now the question is, if the stock moves from 200 to 201, that's the underlying, how much will your option price gain? Well, the answer lies within delta. If the delta is 0.5, then that means for every 1 point movement in the underlying, the option price will gain 50 paisa. So in this case, we went from 200 and 201, so the option price will go from 30 to 30.50. That's what delta calculates. It's the same for put options. Now let's look at the next one, and that is gamma. The gamma is how much your delta will change for every 1 point movement in the underlying. Now, before I explain what gamma is, let me talk about the delta a little more. The delta is not a static number. When your underlying goes from in the money call options to out of the money call options or vice versa, same for put options of course, when we are moving between in the money, out the money, between strikes, the delta will change. Generally, an at the money delta will always differ from an out of the money delta. That's a rule. It will always will be. And when that change happens, we can measure what that change is. That change is gamma. Think of it as the rate of change for delta. It's the acceleration factor you put inside an option contract. So if you bought call options and the market just keeps rising non-stops, the premium may rise exponentially. And this is actually what attracts traders to options so much. Your option contract is dynamic as the underlying moves in and out of the money relative to your strike price. The delta will change throughout these movements. Now we have theta. The theta is really important because it measures how much premium will lose every day as you come closer to expiration. So it's basically measuring time decay. Now I want to talk about the Vega and the Rho. They're not extremely important, but you should know what they are. The Vega measures options change to volatility of the underlying. So as we know, a higher volatility makes the option premiums go higher. The Rho, you shouldn't worry about this too much. It basically measures the options sensitivity to the change in the risk-free interest rate.